Welcome back to the Wealth Alchemist podcast, and today we're going to be unpacking two of the most common investment vehicles, mutual funds and ETFs. We're going to talk about what they are and how they differ, the pros and cons of each, and we'll close with what most people really care about, taxes. So welcome to the show where we turn complexity into clarity so you can build wealth with confidence. I'm Kevin Dick from KDI Wealth Management, and if you've ever wondered, should I use mutual funds or ETFs, then this episode is for you. And even if you're just trying to understand some of the differences between the two, then this show is for you. We'll hit structure, trading fees, transparency, and yes, even the tax consequences, so you can choose what fits your plan and not someone else's. So mutual funds, what are they? A mutual fund really is a pool of money from many investors to buy a basket of securities. So let's say stocks or bonds or both. You buy or sell once per day at the NAV's net asset value price, so whatever the price is that day at NAV, set after the market closes. So funds can be one of two categories. There can be actively traded funds, or there can be index or passive funds, which track a benchmark or an index, say like the S&P. They often have minimums and offer automatic investing, and can even include different share classes which would have different fees, so A shares, B shares, C shares, or I shares. I'm not going to go into too much depth there, but just know that share class does count and can have a big impact on how fees are charged. We're willing and able at any time to answer any questions that you have about that. So what is an ETF in plain English? An ETF is a pooled basket, like a mutual fund in a sense, but it trades on an exchange like a stock, so throughout the day. And most ETFs track an index, though active ETFs are rapidly growing and becoming more popular. Prices move throughout the day, and you can pay a bid-ask spread, so you can buy on the open market like you would a stock, or you can place a limit order where you state at which price you're willing to buy the stock. ETFs typically have no investment minimums, and beyond the price of one share, fractional shares may be available at some brokers, but beyond the price of one share, there's no minimum. So what's the key structural difference? Well, mutual funds create and redeem shares directly with the mutual fund company, and ETFs use what's called an in-kind creation redemption mechanism via authorized participants. So this improves tax efficiency and helps keep ETF market prices near NAV. The pros and cons of mutual funds. Pros: simplicity and automation. They're easy, automatic contributions, withdrawals. They're great for paycheck investing, so dollar cost averaging in. They're great in 529s and many retirement plans. You'll notice one of the things that also makes them easier to own is when they're in a qualified plan for tax purposes, but we'll hit on this again later. Access to seasoned active managers. So some mutual funds have very long track records and very deep research teams to do the grinding work to find out which stocks or bonds to buy in a portfolio. There's also no intraday trading redemption, so the pricing of one daily pricing can protect investors from overtrading or chasing prices. The cons: there's potentially higher ongoing costs, so expense ratios can be higher, and some funds charge what are called 12B1 or marketing expenses. There can also be sales loads in a mutual fund, so A shares, for instance, where you pay a commission up front when you buy the shares, which immediately reduces the value of your share by the difference between the commission and the price, so what would be NAV. One of the cons is tax efficiency in taxable accounts. You can receive capital gains distributions even if you didn't sell, because other shareholders did. There can be trading limitations, so price once at close, and no limit orders after close, or ever for that matter, and no intraday control. So let's say you wanted to get out at midday at whatever the price was trading midday, you cannot. You have to wait until the market closes and the price is found, and then that's the price that you would sell at. And then share class confusion. There's very different fee structures by class, and it can be opaque in some instances. So the best fit signals would be automating contributions inside of a retirement plan, You value manager selection and you're in a tax advantaged account, let's say, so a 401k or an IRA, and you prefer to just set it and forget it and don't need intraday trading. So now what are the pros and cons of an ETF? Well, pros would be cost efficiency. Many ETFs have very low expense ratios, and index ETFs are especially cheap. Tax efficiency, the in-kind redemption process, which minimizes capital gains distributions in taxable accounts. So you're not going to get a capital gain unless you sell. And you're only going to get the capital gain for that which you decided to do, not what all of the folks inside of the fund did, which is how a mutual fund happens. Intraday liquidity and control. You can trade anytime the markets are open. You can use limit orders and stop orders. So let's say that I'm in an index and I feel it might fall. I could place a limit order to sell, or I could place a limit order to buy. So let's say I only want to buy at X price. The stock falls to that price. That turns that limit order into a market order, and I fulfill my purchase at that price. And then stop orders. So let's say I want to put a stop loss. So if this ETF were to fall to a particular price, I can place a price at which I want to turn on a market order, and it will fill. So the stop order triggers a market order, hits that price, turns into a market order, and I fill at the next price. There's some negatives to that too. For the sake of time, I won't go into that, but you really need to understand how stop orders work and reach out to us if you want to understand better. And then transparency. Many ETFs disclose their holdings daily, where mutual funds typically only supply that either semi-annually or annually in the semi-annual prospectus or an annual prospectus. And then the cons, bid-ask spreads and premium discount risk. So you pay the spread between the bid and the ask. So thinly traded ETFs or ETFs that don't trade often, they can be very costly to transact. Trading temptation, because you have intraday access, and it can encourage counterproductive behavior to buy and hold. It's not always cheaper. Some active ETFs and very niche strategies can carry fairly high fees, and complex orders and market nuances. So the need to mind liquidity, so using limit orders and avoiding trading near the open or close in a volatile market. So the best fit signals for owning ETFs would be building a more tax-efficient portfolio in a taxable account, wanting low-cost index exposure with intraday flexibility, and comfortable executing trades thoughtfully. So if you feel confident, or you know your advisor is confident in executing trades thoughtfully, then that would be another trigger for a good fit. So let's do a side-by-side quick hit. Pricing a mutual fund. It trades end of day NAV. An ETF trades at the market price all day. Costs. Mutual funds can have higher expenses and 12b-1 fees. ETFs tend to be a lower cost but add spreads and possibly commissions if you're in a commission-based account versus, let's say, a managed or advisory account. Minimums. Mutual funds often have minimums. ETFs generally don't, beyond one share. Taxes. Mutual funds commonly distribute gains. ETFs are usually more tax efficient, not always, but usually. Always talk to your advisor or the person that you get your advice from. Automation. Mutual funds excel with automatic investing. ETFs depend on your brokerage feature. So are you able to automate purchases? We call them PIPs on the brokerage side of the business. Can you buy in a little bit at a time? And then holdings transparency. Mutual funds, monthly or quarterly with lag, sometimes daily, in telling you what they hold, versus ETFs, which often tell you daily what they hold. So now I'm going to go on and talk about common use cases just to give you some ideas. So retirement plans, 401ks, 403bs, mutual funds really dominate due to the plan infrastructure and automation. Taxable brokerage accounts. ETFs are often favored for tax efficiency and low costs. Active management. Both have active options. Evaluate the track record, process, and fees rather than the wrapper alone. So, the sales pitch about what this fund can do or this ETF can do, and really look deep and understand exactly what their track record is, how they decide what they're going to buy, and how you pay for that advice and that investment. And then dollar cost averaging. Mutual funds really are plug and play. ETFs can work if your broker supports recurring fractional share purchases. Now the tax consequences, what everybody's been waiting for. So let's land the plane on taxes, because the wrong wrapper and the wrong account can quietly drag down your returns. If you own mutual funds and taxable accounts, you can receive an annual capital gains distribution. This could include both short and long term, even if you didn't sell. And this could be caused by manager turnover or redemptions by other investors. So it takes away some of your control of the taxation. Distributions are taxable in the year they're paid. So reinvesting in those shares does not avoid the tax. It just buys more shares. Actively managed funds with higher turnover typically generate more distributions than those that have lower turnover. So sometimes you'll see the term tax efficient fund. And in those cases, they're typically either going to have a way to offset some of the gains, or they're going to try and turn it over less. Qualified dividends may get preferential rates, but ordinary income and short-term gains are taxed at ordinary tax rates. So let's talk about ETFs in a taxable account. ETFs often avoid distributing capital gains due to what's called in-kind redemptions. More tax efficient over time, in other words. You still owe taxes on dividends and on your own realized gains when you sell. And the caveat is that some active ETFs and certain bond commodity structures can and do distribute gains. So check their history and know what you're buying. Tax deferred versus tax exempt accounts. So IRAs, 401ks, Roth. The tax advantage of ETFs versus mutual funds largely shrinks because distributions are taxable currently, and the focus should shift to fees, strategy, and plan access. In Roth accounts, qualified withdrawals are tax-free, so asset allocation can be very powerful. So some practical tips. Asset location. Place tax inefficient holdings, so high turnover, active funds, taxable bond funds, in tax advantaged accounts. Keep tax efficient index ETFs in taxable accounts and or municipal bonds on the bond side. Check distribution history. Look at the fund ETF's past capital gains distributions before buying in a taxable account. And then use specific lot accounting. In taxable accounts, when you sell, you can choose which shares you want to sell of all the shares you own. So let's say you dollar cost averaged in over time. In other words, you added money each month, let's say over a period of 5 years, and you need to get out $10,000 to purchase a car. You might go in and look at which shares you own at what prices and sell the most tax advantaged shares at the time. Always here to help with that. If you have questions, reach out and I can explain that in more depth. And then you really need to pay attention to what's called wash sale rules when tax loss harvesting. So a loss sale rule would be, let's say that I owned a mutual fund and I thought I was going to get a loss, but I moved over to a significantly similar mutual fund in order to take that loss. I may not be able to take that loss. Additionally, it can go the other way, but just what I would advise is always understand wash sale rules and know that your advisor is looking at that when they're making allocation changes. It's very important. A quick disclaimer, this is educational. Again, this is not individual tax or investment advice, so make sure you're always talking with a qualified advisor or a tax pro about your particular situation. And then just to wrap things up, mutual funds and ETFs are tools. So pick the right tool for the job. My dad always said, the job's a lot easier if you pick the right tool for the job. And if you want help aligning the wrapper with your tax picture and goals, reach out. We're always here to help. If this episode helped, share it with a friend and follow the show for more clear, practical guidance. Thanks for joining me today.